For those of you who are watching PWN on the YouTube channel, please be sure to like and subscribe.
So welcome to PWN's January Level Up at Lunch. And this is our monthly meeting held via Zoom on the third Thursday of the month. We offer an environment for professional women to come together to build lasting relationships, professional development, and business connections. Okay, so today we're excited to welcome our featured speaker and our very own board secretary, Sharda Ryan with Wealth Design Group.
I am really excited about our topic today, Secure Your Wealth, Understanding Tax Law Changes from the One Big Beautiful Bill Act. And I'm excited that we've got Sharda, our very own secretary and devoted servant to PWN, leading it. If you are a professional woman focused on building financial security and long-term success, you know that tax laws don't just change on paper. They directly impact how you save, invest, and plan for the future. This timely and empowering session is for you. Today, Sharda is going to unpack the most important tax law changes from the One Big Beautiful Bill Act, what's new, what's evolving, and how these updates may affect our retirement contributions, required minimum distributions, inherited accounts, and overall tax strategy. Sharda, we are so glad to have you here today.
Thank you. Thanks, Elizabeth. Yes, today we'll be talking about OBBBA, also the Secure Acts and another act, because they all kind of build on each other. I'm a financial advisor with Wealth Design Group. This is my disclosure here. It just says, that I'm registered with the state of California to provide advice. But today I will not be providing advice. This is going to be purely educational because tax laws can change often. I'm going to give you some facts, and then you can go to your tax professional to get more information. This is an interesting little quote here. The only difference between death and taxes is that death doesn't get worse every time Congress meets. This quote was, the country was getting started. They were trying to figure out different ways to increase tax revenue. It did get worse every time Congress met, but now it just becomes more complicated. That's for sure. Today, we'll be going over a lot of information. The tax laws can change with each presidential administration. There has been plenty of changes in the past 10 years here. So it started with the Tax Cuts and Jobs Act of 2017. We had the Secure Act 1.0, we had the Secure Act 2.0, and then last year the OBBB was passed. The act contained a ton of other legislation, but today we're going to focus on the parts that affect us, which is taxes. We'll also be talking a lot about retirement plan assets and their tax considerations. So your 401ks, your IRAs. Why does the government focus so much on retirement plan legislation? Well, there's an estimated $44 trillion in American retirement accounts, such as IRAs and 401ks. That's a lot of tied up future tax revenue and spending power. They're also concerned that Americans are not prepared for the income that's needed in retirement, especially since we don't have the pensions that maybe our parents had. We're going to solely rely on Social Security and our own saving as far as 401ks to create that retirement income. I won't be providing advice, but I'll just highlight certain concepts that may apply to you, and you can take it back to your advisors. If you want to know where you are, you got to look and see where you've been. The Secure Act that was passed back in 2019, it stands for Setting Every Community Up for Retirement Enhancement Act. So it was meant to help Americans plan for retirement and make it easier for that. There was also the Tax Cuts and Jobs Act of 2017. And some of those provisions were due to expire on December 31st of 2025. But one of the biggest changes, probably since the ERISA Act that created 401ks in the 70s, was the elimination of the stretch IRA. Typically, if your mom or your sister or your aunt or your dad, if they were to die and left you the beneficiary of their retirement account, you could go and take that over as your own retirement account, and all the rules would apply for your age. They eliminated that provision now. So the only people that can take it over as their own are eligible designated beneficiaries, which are spouse, minor children, ill or disabled person, and any person who's not more than 10 years younger than the owner of the IRA. If your dad left you an IRA, then the IRS wants all of those funds to be distributed from the account within 10 years. That could be substantial, right? 44 trillion. I've seen IRA balances in the millions. So if someone were to leave you $1 million that you would have to distribute over 10 years, how would that affect your taxes? And not just your taxes, but other things that you might rely on verifying your income for. Maybe it affects your covered California premiums. It was a huge change to how those IRAs were able to be taken over by beneficiaries. They know there's all that money in there, and they want to see it, right? They want to see you spending it, and they want the taxes on it. They also increased the required minimum distribution age to 72, also got rid of the limit on contributing to an IRA. Before, if you were 70 and a half or older and wanted to contribute to an IRA and you were still working, you weren't able to. Now you can, as long as you have the earned income if you're over the age of 70 and a half. The Tax Cuts and Job Act gave company structures a 20% deduction of business income on their personal taxes. There's always caveats with these rules that sound great. That's only for sole props, S corps, and partnerships and some trusts. And then also you have to be in a certain trade or industry in order to take that deduction. Be sure to consult with your tax professional if you can take that deduction. And then we had the Secure Act 2.0. What are RMDs? RMDs are required minimum distributions. And why do we have them? Why does the government care about when you take out your money from your retirement account? Or why do they like to dictate when you can take money out of your retirement account? You put that money into your retirement account, not a Roth. Roths are a little different, but let's just say a regular IRA or a regular 401k or 457 if you work for a government. You put that money away and you get to deduct that from your income in that year. So then that account and all those funds get to grow tax deferred and tax free. At some point, the government says, okay, we want our taxes now. Start taking out this much every year when you become this age, and it goes up a little bit exponentially as you get older as well. So maybe when you first take it out, it's 4% ish, but 10 years later, it might be more around 6%. Those are just, they're not exact numbers. Those are just, there's a whole table. When you hear the acronym RMDs, that's what they mean. The Secure Act 2.0, they increased the required minimum distribution age for those born between 1951 and 1959 to age 73. And then in 2023, it's going to go to age 75. I think it's because people are living longer. There was no impact on when you could do your qualified charitable distributions, the age. This qualified charitable distribution, let's say you have your mom and they're charitable. They give money to their church. They give money to nonprofits that they feel passionate about, and they're 75. Let's say they also have considerable retirement plan accounts that they're going to have to take money from at some point or are already having to take money from. Well, you can, instead of making those donations out of your pocket, you can actually send the money from your retirement account. In this case, it's IRAs, not 401ks. You can take that money, send that money directly from your IRA to the nonprofit. It will count for your RMD if you're within that age. And at the same time, it does not count towards your income. So that's huge. A lot of people don't know this piece of managing their IRAs. They eliminated the RMDs for Roth plans, and then you can do a Roth Simple and a Roth SEP if you are a business owner as well. And then some other changes for the Secure Act is that they're giving people more flexibility for their 529s. There's a lot of money also in 529s, and maybe kids don't want to go to school. So there's an option where they can actually convert that 529 asset to a Roth IRA. There's restrictions around it, right? So it has to have been maintained for 15 years or longer. The beneficiary, when they convert it, they have to have compensation. So if their 529 is 25,000, but they only make 10,000 that year, well, they can only to the Roth for 10,000. So if we fast forward now to the OBBBA Act, there are certain things that were made permanent. Now, you may have heard this in the news. The tax brackets from the Tax Cuts and Jobs Act, those were pretty generous. One of the ways to get those tax brackets through was in the legislation, they made them temporary. So they were due to expire at the end of last year, end of 2025. The new act made them permanent. If you hear that it was made permanent, it just means that we don't have that expiration that was due to happen at the end of 2025 on a few things. One of them was the tax brackets. There was also the estate tax and some other things. They also increased the SALT deduction cap to 40,000 for those who are married. MFJ is married filing joint. And that starts in 2025. So even though the act was passed July 4th of 2025, they made it retroactive, some of these tax benefits to be effective in the year 2025. So when you go to file your taxes, they'll have all these numbers in there. The standard deduction was increased. There's some senior deductions and bonuses we'll go over. We'll talk about overtime tips because I know there was some legislation passed around that. This vehicle loan and mortgage interest deduction. And then we'll talk more about 529s, the Trump accounts, and the child tax credits. These are the tax brackets that are effective 2025. And I wanted to show you this so we can talk about tax brackets a little bit. If you look here where it says trusts and estates, they have some reasonable tax rates, these percentages here, right? But the taxable income ranges here are really low. If you want to make a beneficiary a trust, just be aware that it's going to they could potentially be paying a lot more in taxes than if you made the person the beneficiary. So that's a beneficiary idea that you might want to take to your advisor or attorney as far as making sure that your beneficiaries are correct. That, I have to say, is one of the most important things that you can do, because I've observed when beneficiaries were incorrect, and it can be very ugly. Ex-spouses, things like that, getting funds that the person thought that they had changed their beneficiary, stories of, millions of dollars given to someone else. So just that's number one. If I am giving you advice here, is to check your beneficiaries. And if you have any questions about how those should be structured, you can talk to your advisor, or we can talk offline. Also, if you're over here, let's say I'm married and let's say I make 220. Does that mean that my tax rate is 24% on my income? No, it doesn't, because tax brackets are the first 24.8 that I make, I pay 10%. The next 100,008, I pay 12%, and so on. So it's not that entire amount applies to you, it's a blended rate. And one of the things that, people were, especially those that deal with high net worth individuals, were really keeping an eye on was if they were going to make the estate tax exemption permanent. So the estate tax exemption just means that if you die and it's just yourself, let's say you're not married, in 2025, then your estate means everything that you have when you die. So your whole evaluation. Now, one thing to remember is that with life insurance, I'm sure you know that life insurance proceeds are tax-free. Well, but they are also included in your estate. If your whole estate is worth 10 million and you have a life insurance policy payout of 15 or let's say 5 million, well, then your total estate is actually going to be 15 million. And the remainder of that, if they died in 2025, 1 million is going to be subject to estate taxes. And right now it's about 40%. So that means that 400,000 would be paid in taxes. Now, there are strategies to make sure the life insurance isn't in your estate for those purposes. Just remember that, yes, life insurance proceeds are tax-free, but they're included in your estate. And if you have this problem, which is a nice problem to have, then they would be included. 2025 was when they were made permanent. Those are your numbers. 2026, it's increased to 15 million for 30 married, and then it's indexed for inflation after that. So if any of you have this problem, please, you can call me right away. Love to work with you. And then as far as gift, the way the gift exclusion goes is that you can give someone up to $19,000 a year and not have to report it. If you give more than that, you have to file a form with your taxes. It doesn't mean that you have to pay tax on it. It just means that it needs to be recorded with the IRS and tracked, because the the gift exclusion life for someone's lifetime is 15 million. So it's easy to remember. So if you give more than 19, you got to file the form. The most you can give without having to pay taxes to somebody over their lifetime is 15 million. With the new act, the standard deductions for being single is 15.75, married filing jointly 31.5, and then head of household 23,625. So this is where you say all of your W-2, all of your income, you made so much money. Well, the IRS is going to give you a break. They're going to say, okay, well, you made this much money, but we'll reduce your income by the standard deduction, and then we'll start talking about how much taxes you owe. And as you know, there's other deductions that come along with that, but that's like one of the top line deductions. The SALT, deduction, which is really important, especially for us living in California, that was increased to 20,000 if you're single, 40,000 married filing jointly. But this one is due to expire. But what's nice is that it's effective for the 2025 tax year. Also are going to be some phase outs. So you may not be able to get this full SALT deduction if your modified adjusted gross income is over 250 if you're single, 500 if you're married. So just remember, sometimes there are caveats to certain deductions. There did a lot more to help with seniors, like we talked about before. The government is concerned about seniors not having enough for retirement. The existing senior deduction is here, so a little over 2,000 if you're single, 3,300 if you're married filing jointly. OBBBA Act gave an extra 6,000 additional bonus for seniors and 12,000 for married filing jointly, but you both have to be seniors for the 12,000, and it's an above the line deduction. So again, it's one of those things, one of those deductions, just that acts just like your standard deduction. Of course, here's the catch: that deduction phases out. So if you make 75, more than 7,500 and you're single, or 150 and you're married filing jointly, you may not get that whole bonus. And again, the bonus is only available for the tax years 2025 to 2028. So overtime and tips, as far as the tax changes here, is that they're not exempt from tax. It's only a deduction for income tax. You still have to pay your FICA on any overtime, and it's an above the line deduction. This is how much you can deduct for overtime pay, 12.5 for single, 25 for joint. And again, here's a phase out. If you make more than 150 and you're single, or 300 and you're married filing joint, you potentially could have no deduction for your overtime pay. Tips, the max is 25,000. It's not increased for joint filers, so it's 25,000 flat. There's also going to be a phase out for that as well. If you make more than 150 or married filing jointly, phase out just means that a phase out is just a way of saying you're not going to be able to get it anymore. It applies to your 1099 workers. It's for the tax years 2025 to 2028. This is a temporary provision of that. Again, they tried to help with the some of the flexibility for your 529s. It expanded the expense definitions so it can be elementary or secondary, private, religious. They expanded some of the qualified higher education expenses to include credentialing expenses. They increased the beneficiary limit on cash distributions, and this starts 2026. They also increased the child tax credit starting in 2025. And then there is a new account that has been formed. Don't know if it's fully funded yet. There's still some questions if it's going to be funded yet, but we'll see if it will be by the time to start July 24th of 2026. It's a tax exempt IRA for children under the age of 18. There's limitations on contributions. The government will give you 1,000. There's rules as far as who can get that 1,000. Employers are able to contribute, which is nice because it gives a way to employer to give employee benefits. And then in order to take the money out, you would have to use it for a qualifying purpose, and something like starting a business or buying a first home or attending college. That's what you would be able to take the money out. And there's always also some restrictions as far as what type of assets you can invest in. And then here's the important numbers to know for 2026. Your IRA contribution limits 7,500 if you're over age 50, like myself, it's 8,600. If you have coverage at your work, can you deduct the contribution? And then there are income phase outs for the contribution deductibility as well. So you can always contribute to the IRA, but it depends on if it's deductible to you in that year. And then that also, even if and sometimes people will commingle those assets with deductible IRA assets. So it's very important that you keep that tracked throughout the years. There's a special form that your tax preparer or that you file that says that the funds are non-deductible. So when you go to take them out, there's rules around that as well. And then, I hear a lot of people talking about Roth IRAs. You should start a Roth IRA, a Roth. Well, you also have to be, because if you make more than 168, you're not eligible to contribute to a Roth, and there's penalties for doing that. So that's why it's always very important to work with an advisor as far as, how do I plan for retirement? What kind of account should I even start with? It's going to depend on, whether you're W-2 or you're a business owner, how old you are. There's a ton of different considerations when contributing to retirement accounts. People also will sometimes, if they make too much money here, like with the 168 or the 252, you can do a backdoor Roth. But again, these are very sophisticated strategies to do a backdoor Roth. And that's something you would want to get advice from your tax professional or your advisor. But it is possible even if you make more than 168 or 252 if you're married. And then here are your limits for contributions for your 401k, 403b, 457, if you're government or teacher. So your limit is 24.5 if you are ages 50 to 59 and over the age of 64, you get to contribute another 8,000. Then to make it super confusing, If you're 60 to 63, you can contribute 11.25. So that it kind of created a little bonus catch up for the ages of 60 to 63 in the Act. There's your SEP IRA. This is a calculation you probably want to do with your CPA because it's kind of a number you have to back into, but it's a good amount that you can get into your SEP IRA and also into your solo 401k, which is 72. Your solo 401k, that's your employee contribution. You can also do your profit sharing contribution into solo 401k. So many times you can get a lot of money into the solo 401k. Some companies will have it's called a simple IRA instead of a 401k. They're a little easier to administer. What else should you know? So make sure you review your retirement plan structure, whether you're with a company or a business, or if it's just on your own. Look at your tax strategy and see if there are different ways that you can maximize the rules, especially the new rules. Implement those action items so this is one of my favorite investors, Warren Buffett. He is just a legend in our business. I like this saying, someone's sitting in the shade today because someone else planted a tree a long time ago. I just think that's so amazing and powerful, because even if you start $50 a month, you can create an income for yourself and possibly some funds for your heirs down the line. And then here is my contact information. You can screenshot that if you'd like to talk about any of the strategies here.
You explain it very, very well, I must say, because a lot of these terms and information is, it can be overwhelming. Thanks for being here. I really appreciate it. Thank you, Sharda. That was excellent. And everyone have a great rest of the day. Thank you.